Welcome back to The Money Maze, the podcast for South African retail investors who want to stop feeling like they're drowning in jargon and start navigating the markets like someone who actually knows what they're doing. I'm your host Jay, and today we're kicking off a brand new series. So we've done the lingo, we've survived the acronyms, and we've built up a decent dictionary of stock market nonsense. Now it's time to put it all into practice. This new series is about one thing: how do you actually start investing? But let's first ask, why even bother investing? Well, here's the thing. If you're working for a salary in South Africa, you already know your money isn't exactly stretching like it used to. Petrol, pop, and even a decent bunny chow, chewing through more of your budget every year. Inflation is the silent pickpocket in your wallet. And if you just leave your cash in the bank, it's basically sitting there drinking Castle Light while losing value. Investing is about putting your money to work so that it grows faster than inflation. Think of it as sending your rands out to hustle while you sleep. And unlike your cousin who always promises to pay you back next month, the market eventually does. So the first big thing is your mindset shift. Most people think investing is only for the rich. The guys in Sandton with 3 golf club memberships and a car that costs more than your house. This is not true anymore. Platforms like Easy Equities and Satrix have changed the game. You can literally start with $5. That's less than a packet of knickknacks. The trick is not the amount you start with, it's consistency. Investing $100 every month for 10 years beats dumping $10,000 and forgetting about it. Why? Because of the 8th wonder of the world, compound interest. Einstein supposedly said that, but even if he didn't, he was clever enough that I'll give him the credit. So let's see at step 0, before you start. Before you even buy your first share, let's be honest. Do you have an emergency fund? Because if your geyser bursts and you have to sell your shares to pay for it, that's not investing, that's panic trading. At least 3 months' expenses in a boring old savings account is your financial helmet. You don't start playing rugby without a scrum cap, same principle here. And debt? Well, if you're paying 25% interest on a clothing account, you're not ready to invest. You're just digging a hole and asking the market to throw you a rope. Spoiler, well, it won't. So where to invest? And this is without giving you any advice. Let's talk options. In South Africa, you've got a few main options. The JSE, this is your local playground. Shares in companies like Shoprite, Sasol, MTN, yes, even Pick n Pay, though lately it's like investing in a braai when the wind keeps blowing the fire out. Then you've got ETFs, or exchange-traded funds. These are baskets of shares bundled together. Instead of picking one company, you get a slice of 40 or 100. It's like ordering the platter instead of just one chop at the braai. Lower risk, and it's often cheaper. Then you've got unit trusts, which is similar to ETFs, but managed by a fund manager who charges fees to do the heavy lifting for you. Some people like the buffet, others prefer a la carte. Just remember, fees eat returns the way moths eat your favorite Springbok jersey. And then you've got offshore investing. Thanks to platforms like Easy Equities, you can also buy US stocks like Apple, Microsoft, or even Tesla. This lets you hedge against the rand, which has a talent for collapsing every time a politician opens their mouth. So how do you actually get started? Well, here's the practical side. You open a brokerage account. Easy Equities, your bank, or whoever you trust. It's like opening a bank account but for investments. Decide what you can afford monthly, whether it's $100 or $1,000 or more. Set an amount you can stick with consistently. Pick your starting point. For most beginners, ETFs are a great entry, but remember, I'm not telling you what to buy, that's part of your homework. Set debit orders. Automate your investing so you don't forget. You don't forget your Netflix subscription, so why forget your future wealth? And stay the course. Markets go up and down. If you panic and sell at the bottom, you've just donated money to someone smarter than you. The psychology of investing. Well, here's where most newbies fall flat. The hardest part of investing isn't the math, it's the emotions. You'll open your app one day, see your portfolio is down 15%, and suddenly you're sweating more than a boerie on a grill. The trick is to zoom out. One bad week doesn't sink your plan. Think long term, years, not days. Patience is the investor's best friend. So common mistakes to avoid. Chasing hot tips. If your taxi driver tells you to buy Sasol, it's already too late. not diversifying. All your money in one share is like only bringing garlic bread to the braai. If it burns, you're going to go hungry. Forgetting about fees. Small fees compound into big losses over time. Always check the cost. And then timing the market. Even pros get this wrong. Timing the market beats timing the market. Let's do a recap. Your Stokvel Starter Pack of stock lingo of this how-to edition. Inflation is the silent thief. Investing is how you fight back. Start small, but stay consistent. Build an emergency fund first. Use platforms that make it cheap and easy. Think long-term. Avoid panic and don't chase hot tips. And that's your starter pack for beginning the investment journey. So we've now set the stage on how to start investing series, and over the next few weeks we'll get into choosing platforms, understanding risk, building a starter portfolio and keeping your head when everybody else is losing theirs. While my jokes may be more compound than compounded interest, remember, this is not financial advice. Please do your own research and speak to a licensed advisor. I'll catch you next time, same place, same sarcasm.